Thanks for joining me this Friday, the 21st of February. I'm Grady, market analyst with Bell Direct, and this is our weekly market update and reporting season coverage video for week 3 of this reporting season. So far this reporting season, as we hit the tail end of the important results period, 84 companies have reported, with 30 beating expectations, 27 missing expectations, and 27 meeting expectations. A large number of the misses have been in the energy space amid volatility in the industry over the first half, while gold miners and niche retailers have been key sectors that have topped expectations. Australian corporate conglomerate Wesfarmers posted a slight beat on an earnings front for the first half and a solid overall trading update, despite only posting single-digit earnings growth for its key retail names. For the first half, Wesfarmers reported group revenue rose 3.6% to $23.49 billion, EBIT rose 4.7% to $2.3 billion, NPAT climbed 2.9% to $1.47 billion, and the company's fully franked interim dividend was declared at 95 cents per share. From a segment perspective, Wesfarmers' results were driven by WesCEF, the industry-leading chemicals, energy and fertilisers business, which reported single-digit earnings growth of 9.5%, so the upside of single digits, to $1.2 billion, while the company's Kmart brand continues to excel, with sales growth of 2% to $6.2 billion. Elsewhere in the retail space, investors had mixed reactions to Super Retail Group and Universal Stores out this week. Universal Stores, which has garnered a buy rating from Bell Potter's analysts, posted excellent results out yesterday on Thursday, further adding to the story of strength among niche retailers in H1, with 16.1% sales growth on the prior corresponding period to $183.5 million, underlying EBIT up 14.9% on the prior corresponding period to $35.4 million, gross margin expansion of 90 basis points despite continued discounting from peers, and the company declared a 33% rise in the interim dividend to 22 cents per share. Universal Stores target the younger demographic, which have little to no cost of living pressures and spend their weekly wage on fashion and the latest trends, like at the Universal Store. On the other hand, though, Super Retail Group had margin contraction in the first half, suggesting inflationary pressures ate into profits. Super Retail Group also posted a rise of 8% in inventory to $69 million, significantly more than the $28.5 million inventory posted by Universal Stores. Inventory is a key metric investors should assess for any retailer in this reporting season, as a higher inventory level leads to higher promotional activity required to move the stock or even write the stock off as a cost to the company. So that's something to keep in mind when you're looking at the retailers as an investor. Toll road operator Transurban impressed investors with solid first half results, including slightly paying down debt, of which toll road operators are known for holding a really high level of. A 9.4% rise in operating EBITDA was also posted thanks to a return to office policy across most states in Australia, and the company reaffirmed distribution guidance for the full year at 65 cents per share and declared a 32 cents per share dividend for the interim payout. On a broad level, let's assess the key areas we are seeing trends arise this reporting period. Dividends have been a key focus this February, with a mixed bag of changes to key corporate payouts. In the materials space, a downgrade in dividends paid was expected this reporting season and saw BHP reduce its dividend by 30%, while Rio reduced its final dividend to $2.25 US cents per share, taking the total year dividends to $4.02 per share for the year, which is the lowest level Rio has paid out since 2017. Elsewhere, A2 Milk Company introduced its inaugural dividend of 8.5 New Zealand cents per share due to higher sales in China and the US. Sonic Healthcare and Wesfarmers also surprised the market with dividend increases of 2.3% and 4.4% respectively. And Telstra Group also raised its interim dividend with a payout of 5.6% to 9.5 cents per share amid a strong profit lift in the first half of 2025 that beat analysts' expectations. As for the outlook for the second half of 2025, so far we have seen a broad picture painted for key sectors that continue to face inflationary cost pressures like utilities companies, while broadly retailers are expecting subdued demand to continue in the second half. Materials companies, on the other hand, are expecting a key rebound in commodity prices thanks to increasing demand from from China. Expansion into the data center and AI space is expected to continue well into FY26, especially after Goodman Group announced a $4 billion capital raise in results out this week to turbocharge its data center portfolio growth. And the financial sector has come under pressure amid soaring valuations, net interest margin peaking, and on the back of the RBA entering the rate cut part of the rate cycle. Let's look at the market this week elsewhere. Locally, from Monday to Thursday, the ASX 200 posted a sharp 2.72% decline as a 6.3% drop in the financial sector, as we just mentioned, weighed on key market gains. The sell-off in financial stocks is primarily due to investors seeing value elsewhere in the market on the back of the RBA rate cut announcement this week, which reduces earnings growth potential for our banks. The winning stocks on the ASX 200 this week were led by Megaport, soaring almost 29%, A2 Milk Company rocketing 26% on very good results, and Audinate Group rising 17.81%. On the losing end, Mineral Resources tanked almost 21%, while Bendigo and Adelaide Bank fell 18.18%. On the broader market index, the All Ords fell 2.53% over the 4 trading days, as Winsome Resources fell 24.71%, while Redex ended the week down 20.88%. The most traded stocks by Beldirect clients from Monday to Thursday were Fortescue, PM Capital Global Opportunities Fund, and CSL. Clients also bought into Woodside, Westpac, NAB, CBA, Pilbara Minerals, and Pro Medicus, while taking profits from Charter Hall Social Infrastructure REIT. The most traded ETFs by our clients this week were led by Vanguard Australian Shares Index ETF, Vanguard Australian Shares High Yield ETF, and Beta Shares Australian Technology Tigers ETF. On the economic calendar front next week, we may see investors react to US GDP growth rate data for Q4 out on Thursday. US durable goods orders are also out on Thursday. US PCE price index for January, personal income and personal spending all out on Friday, and of course key Chinese manufacturing PMI data out on Saturday next week. On the reporting season calendar next week, we will see results out of Ampol, Iress, Steadfast Group, Woolworths and Coles, Atlas Arteria, Qantas, Dicker Data, Ramsay Healthcare, and Star Entertainment Group, among many others. And that's all for this Friday and this week. We hope you have a wonderful weekend and happy investing.